Ladies and gentlemen, welcome back to another ICT 2024 Mentorship Student Review. Today we will be reviewing the September 19th live stream from ICT, and the topic is micro versus mini futures. Before we get into the video, I would closely advise you to read through the risk disclaimer. This video is only for educational purposes and trading involves risk. So please read through the risk disclaimer before we continue on. With that said and done, again, I'm not stealing ICT concepts. I'm just providing you a view from a student perspective with the key takeaway points of today's live stream, which was on Thursday. So we will compare the relationship between the micro and the mini contract in today's ICT did this in today's live stream. So we have the micro futures on the top and corner right here, and down here we have the E-mini Nasdaq future. Again, ICT outlines the opening range gap, as you can see right here. That's what we always do as we start the trading session at the opening bell at 9:30 a.m. Eastern Time. And he mentions that we're already trading the December contract for the Nasdaq and the S&P and Dow Jones. ICT would have been already short. Right here you can see his cursor, he's pointing out to that. He would have been short from the 15-second fair value gap if we hadn't seen such a large opening range gap, which was about 300 to 400 handles. So a pretty large opening range gap. And ICT will do its execution today on the micro, which we will see later on. And tomorrow's lesson on Friday, the 20th of September, will focus on CFD trading for those of you who are interested in that. We will also cover this live stream, so come back tomorrow to hear more from that. I'm also very excited for tomorrow's lesson. So on days where we have a large range opening gap, we wait for the market to take out the intraday high. In this case, on the 15-second chart, currently it's this high. And simply because the market has just opened up for about 4 minutes, 4 to 5 minutes, it has opened up. You can see the time step here. It's 9:36 a.m. You don't rush to take a trade. Again, the first presentation fair value gap on the 1 minute chart is key right here, and we have already, you can see the idea from ICT played out. We took out the intraday high right here, and we have validated any breakout traders who were going long above this high. So this is setting up a retail trap. Now, do you think the breakout traders are feeling safe right now when they have bought above this high, when they bought the breakout? Do you think they're feeling safe right now as the market retraces lower? Probably not. So traders are caught long buying the breakout, which creates sell side liquidity below this low. ICT outlines two scenarios. Scenario one is the market can use the consequent encroachment of the fair value gap on the 1 minute chart right here, which is the first presentation fair value gap. And from here, it should trade into the 15-second SIBI right here on the 15-second chart. And scenario two is that we leave this fair value gap, first presentation fair value gap, to the downside, retrace back into it, and stay and work in the lower half of the fair value gap and treat it as an inversion fair value gap to trade lower into the sell side liquidity pool. So these are the two scenarios outlined right here, which ICT outlined right here, and we're anticipating a run down into the mid gap. It doesn't mean that we will do it today in the morning session, could have happened in the afternoon session. So again, if we think back to our last lesson, if we have an opening range gap, the first 30-minute bias is that we will seek a return to the mid gap price. So currently we're above it, we're seeking Our bias is short and we're seeking shorts to the mid gap. Again, ICT is watching the mid gap of the fair value gap right here. The consequent encroachment, if we would break below it, we would like to see a run down below this low. You can see the market traded into the SIBI right here, into the upper portion and to the lower portion of that SIBI right here, as he outlined in his first scenario. And now we're going over to scenario 2. We would like to see the market treat this as an inversion fair value gap. So ICT went short on the low of the first presentation fair value gap. He had a bad fill right there. He's short from this red line. And he wants to see price stay in the lower portion of this first presentation inversion fair value gap. And we want to see the market make a sharp run lower into the sell side liquidity, because we have already trapped the breakout traders above this high. If the market gaps several hundred handles, it's very likely to play out like this, that the market drops lower, and as the market drops lower, the retail indicators are going into an oversold condition, so they're buying right here, and breakout traders are being trapped long, so we run the intraday high, and then we reverse lower, and then we try to attack the sell side liquidity, so we're going against retail logic. Retail is buying, we are selling and taking profits at their stop losses. So again, if we have two fair value gaps, we always take the upper one. We have an ICT 2022 model, buy side liquidity right here. Run the buy side liquidity, break below a short-term swing low. Market creates a fair value gap. We retrace back into it, into the upper fair value gap. And you could have taken a short right there as well, which would be the ICT 2022 model. So ICT is short, we're $99 in profit. And if you would aim for $100 with a micro contract, again, he said he will trade at a micro mini NASDAQ, and that's what he did. He's short one contract with the micro, and you can see if your aim was to make $100 a day, then you would have closed the trade right here. But he held the trade. Again, you see stop loss already at break even. If you would have held the trade and not closed the trade right there, you should document how you're feeling with this while holding the trade. Do you feel any kind of regret as the market retraces? If you see any green candles, are you saying to yourself, yeah, probably should have closed the trade? And these emotions, you should write them down in the blank spaces of your chart. This helps you with your journaling and the basic understanding of your basic psychology and how you react to market moves. So ICT got stopped out at break even, roundabout where he had his stop loss and profit. And how are you feeling if you would have left $100 on the table? He probably did that so his students can learn, but I would also advise you to record your emotions in these blank spaces right here. So we're trading back into the first presentation fair value gap, which is now shaded in orange. Remember, this was the gray shaded area, which now turned orange. And ICT is watching if we can now drop below this inversion fair value gap, which is the first presentation fair value gap as well. And then if market drops below that, we should form a SIBI somewhere right here to go short and target the lows right here. And always ask yourself, can the move yield you at least 20 handles? So if market drops lower, we form a SIBI somewhere right here. Does the market offer you a run to this low of at least 20 handles or to this low? Yes, it probably would have done that. Now let's see, market drops below the inversion fair value gap right here, but there is no SIBI, so we are not going short. We're just staying on the sidelines and everything is rigid and rule based. No CB, no entry. Okay, and now we're already on the last slide. So if you would have been short from this level right here where ICT shorted, how far can price trade below the sell side liquidity pool? Simple answer, you probably know it already. Just use your fib extensions from this high to low. 0.5 retracement extension level. Market hits that perfectly. You would have been in profit around of $100 right here. So here you can take 80% off if you want to leave a runner into the mid gap level, or just close for the full profit of $100. Here we have another standard deviation of a full standard deviation. Market didn't trade to that. Okay, and then we are coming into, let's go into the new concept ICT kind of presented of a new balanced price range. So you can see the red box is the balanced price range. Now you're asking, how is that? You can see this red box basically consists and starts at the intraday high right here, which we ran out, which was used to create a buy-side liquidity pool where retail traders got trapped long. And if you pull the red box from this high to this low, you will get an extended to the right, then you will just get this level. And we treat this as a balanced price range. Then the market comes up, trades above this high again, and now this will naturally act as real support and resistance. You can see market trades higher from there. So again, if we have an inducement of buy-side liquidity, market runs this out, then we trade lower, take out the sell-side liquidity pool, market comes back up, then you can expect the market to treat this level from this high to this high as natural support and resistance. And now you're asking, the live stream is 1.5 hours long. Why is the video already over? It's because ICT goes on a rant from about, if you would use the timestamp of 1 hour and 5 minutes, from there on, ICT kind of goes on a rant and the technical stuff ends here. And then you can watch the rant for yourself. I will leave the link to the live stream in the description below this video. And I hope you have enjoyed this video, and we will see us tomorrow where ICT will talk probably more about CFD trading with the indices. I wish you a well evening, and we will see us tomorrow. Stay safe, trade safe, bye.